One. And welcome everybody to another episode of Smart Money Circle. I'm your host, Adam Sarhan. With me today is Brian Feroldi, who's a financial educator and has a very large audience online, author of a very good book, and a whole lot more. Brian, thank you so much for joining us today.
Adam, awesome to be here. Thanks for having me.
So Brian, I always like to begin. Can you tell us a little about your journey and how you got to where you are today?
Sure. I graduated from college in 2004 with a degree in business, and I had no idea what I wanted to do with my life. I think college did a great job of prepping me for how to live on my own, but it did a really poor job about prepping me for really important money decisions that I was about to make. For example, I vividly remember after I signed up for my first job, I was sitting down with my 401k documents. The HR rep was across the table from me, and she said, "What do you want to do?" And I looked at the choices, and I was like, "I don't know what any of this means.
Right?
Can you help me?" And her answer was, "No, I'm not allowed to help you." And I remember being like, that seems insane. Like, this seems like really important information that I need to have. And I literally know nothing about what a 401k is, a company match. My choices were, do you want high growth, medium growth, or low growth? And I was like, high growth, I guess.
Yeah.
And I just remember being completely clueless about some really basic things about money. Now, from there, my dad gave me a copy of a really influential book in my life called Rich Dad, Poor Dad. While today I disagree with many of the things that are taught about, that kickstart an absolute love affair that continues to this day with me wanting to learn everything I can about money and business and finance and personal finances and building wealth. So for the last 20 years, I've been studying intensely on my own related to anything to do with money and personal finance. About 18 years ago, I kind of fell in love with the stock market and have been educating myself since. And then a few years ago, I started posting feverishly online and wrote a book, and that brings us to today.
Excellent. I love it. What a phenomenal story. So let's talk about your investment strategy a little bit. Are you more of a fundamental Buffett style investor? Are you technical oriented, a combination of both? Or, if you could speak to that a little bit, we'd appreciate it.
Yeah, so I firmly am a bottoms-up, business-focused investor. I think that the stock market, I love the Jack Bogle quote, which is, the stock market is a giant distraction from the business of investing. So I don't look at technicals or anything like that at all. The thing that I'm trying to do when I'm making an investment is I take a company that comes on my radar. I run it through my checklist, my investing framework. If it's a match for me and my investing style, I'm going to buy that stock with the goal of holding it indefinitely. My favorite investments are the ones that continue performing for years and years and years on end, but I don't consider the technicals or anything like that at all. The only thing I want to know is, do I think that if this company executes, that it can be substantially bigger 5 years from now, 10 years from now, 20 years from now than it is today?
Gotcha. And then what kind of fundamental metrics do you look for? Are you big on cash flow? Are you big on any specific metrics, or how do you determine the answer to that question?
Yep. So there's a bunch of categories that I look at. And here's an exercise that I recommend to anybody that invests, whether you invest the way that I do or not. One exercise that I went through a few years ago was I wrote down every single business attribute that I would find attractive as an investment. So for example, I like a strong balance sheet. I like a high gross margin. I like free cash flow, like high returns on capital, founder-led management team, high inside ownership, widening moat, optionality, low customer acquisition costs, etc. So I made this big list.
Right.
Then I forced myself to rank it from most important to least important. That is actually a really critical step.
I was about to say, that's genius. Yeah, that's awesome.
Second thing I did was I made the exact opposite list, which is, what are the things I don't want to see in investment? So for me, that's things like customer concentration, over dependence on an outside force, such as commodity prices or interest rates or a strong economy. I don't like high stock-based compensation. I don't like it when there's currency things that are going on. I don't like it when there's antitrust concerns. I don't like it when the company grows by acquisition, etc. Same thing. I then ranked it from worst quality to satisfactory quality. Then I assigned the most important qualities to me, a maximum of 100 points. And I forced myself to rank them in order and dole out points based on criteria that I thought was most useful. In essence, I created a weighing system for my criteria on both the positive attributes and the negative attributes.
Yes.
After completing this process, refining it and going through, I'm on version 3 now, and importantly, getting feedback from other investors. I can now take any company that I come across and run it through this framework in about an hour or so. And what the output of that framework is, how high quality is this business, and how strong of a match is it for what I'm looking for in a potential investment.
Right.
And then, broadly speaking, I allocate my capital to the ones that are a best match and avoid buying the ones that are a worst match.
That's really, really, really a great process. So let's talk about value for a second. I know value is subjective, like beauty, it's in the eye of the beholder. How do you determine if something is undervalued or overvalued? If, let's say, it matches all of your criteria, but the stock is trading at exceptionally high, screaming levels where just overvalued, how do you solve for X?
Sure. So the quality screen that I put my stocks through is step 1, and by far the most important step. Mm-hmm. I personally am a value investor at heart. I really, everything that Warren Buffett has ever said just totally makes sense to me. So that was the lens that I looked through my investment world for many, many, many years. I have slowly learned the hard way that emphasizing valuation can be a massive mistake. And if emphasizing valuation causes you to not buy the next Netflix, not buy the next Amazon, not buy the next Salesforce, then that is a huge problem in your investing process. So my current view on valuation, which has changed drastically, I'm sure will change again, is essentially the higher the upside potential and the higher quality of the business, the less I pay attention to valuation. The lower the potential of the business, or the lower the return potential of investments, the more I pay attention to valuation. For example, if I came across a company that was worth $1 billion today, and I legitimately believe that could be a $50 billion company if it executed, valuation's not even going to be on my radar.
Understood.
I'm just going to buy it.
Yeah.
However, if I was going to buy Apple today, or Microsoft today, or some big mature company that's best case scenario growth rate is likely to be in the high single digits, boy, am I going to emphasize valuation. It's probably going to be the first thing that I look at. So it's a sliding scale based on what is the upside potential of the investment.
I love that. And then how do you actually determine value? Is it based on the PE ratio? Is it forward, trailing? Like, how do you determine it?
It depends on the stage that the business is in. This is another massive mistake that I've made along the way. Mm-hmm. It's really important for investors to get in their head the concept of the business growth cycle. So at the start, when a company is first founded, oftentimes the only thing that the management team is focused on is revenue. That's it. Everything else comes second to revenue. They are capturing customers, they are expanding, and the bottom line, profitability, is not a focus for the business at all.
Nice.
For these companies, PE ratio is useless.
I agree.
Price to free cash flow is useless, because the bottom line, the profitability of the business, is not a focus. The top line is. For these kinds of businesses, the only thing that you can look at in many cases is price to sales, or if you're lucky, price to gross profit, or even if you're luckier, price to EBIT ratio, for example. Conversely, if a company is fully optimized for profits, it's mature, it's reached the mature phase, and it is focused on bottom line profitability, then and only then can you use the price to earnings ratio. So the metric that I pay attention to depends on where the company is in its growth cycle.
No, makes perfect sense. So I've had a lot of people on the show that manage a ton of money, that are very strong value investors. And I love your process, because it is different than most of what they do. My question now, I get the fundamental side. How do you handle risk? And what are some mistakes you make, or you've seen people make, with respect to risk management? Because if you love a company and you think the company has tremendous growth, $1 billion to $50 billion, or, get your Starbucks when they had 500 stores before they had a gazillion stores, right? And let's say you're wrong and the stock goes from 100 down to 10, or Netflix just dropped 80% in the last 6 months. So how do you handle risk, and what mistakes you see people make with respect to risk management?
Well, I'm guessing compared to the way the most people you talk to on the show, the number one way I manage risk is by not managing anybody else's money.
Okay, fair enough.
I am only managing my own capital, period. The only person that I have to answer to is myself. I don't have to, I don't mind underperforming over short periods of time. I'm not going to fire myself. I don't have to do window dressing. I don't have to worry about expense. I don't have to worry about proving myself to anybody else except for myself.
Yeah, and you don't have the pressure from them either. I hear that loud and clear. Yeah, that's very powerful.
I can't imagine how hard it is to manage somebody else's money. It's really hard to manage your own money.
Brian, I got to tell you, it's one of the most undervalued kind of performance-driven businesses where people just don't understand it. It's almost like chocolate. What does chocolate taste like? You can't explain it until you actually taste chocolate. But once you taste the chocolate, I can't give you vanilla and be like, that's chocolate. You know it's chocolate. So what you're going through here, and then having that additional upside of managing the money, that's why hedge fund managers get paid so much when they're right and they perform well, because it's well-earned money. I mean, it's one of the most difficult things to do. But anyway, yeah, you're 100% right on the money. So keep going.
So that's thing one. I only manage my own money because I can't imagine how my decision-making process would be changed if I had to think about minimizing drawdown, or how am I going to explain this move to a client. In fact, I saw a great quote recently that your risk profile is either what your client's risk profile is or yours, whichever is lower, or whichever was worse.
I get that. Yeah, exactly.
Right. So that's thing one. Thing two is I hyper practice and hyper preach the barbell method to your finances. What I mean by that is,
explain that in case people don't understand.
My personal finances are ridiculously conservative. They are hyper conservative. What I mean by that is we have multiple sources of income. We have a very, very high savings rate. We have a 6+ month emergency fund. And we have zero debt of any kind to our names, zero debt. That extreme conservatism on the personal finance side makes it so any volatility that my investments experience has zero impact on my day-to-day life. Right. Zero. My house isn't at risk because of volatility. My car isn't at risk. Where we live, nothing is at risk because of volatility. Yeah. That gives me the mental capacity and mental fortitude to deal with extreme amounts of volatility in my investment portfolio. Right. That's why I don't mind buying lots of high growth companies in my investment investment portfolio and staying 100% stocks, 0% bonds, because the volatility, while can be mentally challenging, in no way threatens anything about my life. Yeah, and that's very smart. Keep going. And then the third way that I manage risk is by diversifying. I personally own a dozen stocks or so, and it's really, really hard to tell in real time which companies are truly going to be the outperformers of the future, because everything that you have to make that decision is the information you have now looking backwards. Yes. But the future is always unknown. And you are essentially betting, in many cases with the style of investments that I have, that this company is so fantastic that it's going to outperform even very, very high expectations, which is what the best companies of the last 20 years have done. So you're betting on the future execution of a management team. And I don't know which ones are going to execute. So I am happy to buy small positions in lots of stocks, and then importantly, give them plenty of runway to prove themselves. So I am a very reluctant seller, sometimes to a fault, because I know that all of the greatest stocks of the next 20 years are going to experience massive drawdowns. Yeah, massive 100%. Drawdowns. 100%. And if you sold Netflix in 2011, after, by the way, an 80% decline, you missed out on a fortune over the next 10 years. Understood. Are we dealing with that right now? I don't know. Yeah. Netflix is down big. What's the next 10 years going to hold? I don't know. But this is a company that has a history of executing very, very well. So I'm very reluctant seller. For that reason, that reluctance to sell and my purposely taking small position sizes causes my portfolio to concentrate itself into my best ideas. So if you look at my top holdings today, they are not picked by me. They were picked by the companies executing extremely well and their stocks going up so much that they earned a higher and higher portion of my portfolio. And my losers, which I have plenty of, have essentially faded away into obscurity, and all they are is a future tax write-off.
No, I hear you loud and clear. So that makes a lot of sense. So I published a book and it's called Psychological Analysis. The idea is a third school of thought in addition to fundamental and technical. And what you're saying here is ringing so true. So the 2 points you mentioned, one is mental capital, that you have your market investments in a silo almost, where it's 100% independent from your day-to-day lifestyle. And even if that goes to zero, which it won't, but if it does go to zero, you have the clarity and the ability to live a life and it doesn't impact you whatsoever. So you're not really making emotional decisions, which is another fundamental part of the book, is learn how to make rational, not emotional decisions with your money. And then the second point is the looking forward and looking backwards. And you're 100% right. And I talk about this where it's almost like when you drive out of your driveway, you have your rearview mirror, but you can't drive on the highway looking like that. But whenever we get earnings data or economic data, it tells us what the jobs report, what happened last month, but the market's looking forward. And that disconnect, most investors aren't able to understand, let alone deal with. I love what you're saying here. So Brian, let me ask this question. When you have an investment, what is your normal position size? You taking 1% positions, 5%, 2%? And how do you know when you're wrong? Let's just say you are wrong. And like you said, you're a reluctant seller, but when do you ultimately get out?
So as far as position sizes, I view my portfolio like a cruise ship. So if I want to change direction, boy, is it going to take a long time for that direction to really come to fruition. So yeah, I buy roughly in 0.5% positions. So I ebb in really slowly, really slowly over time. The other thing that's worth noting about that is it's common for people to talk in percentage terms, which makes total sense, but the absolute dollar amount really matters. For example, if I was investing, if I had $10,000 to my portfolio name, you can bet that I'd be buying in 5% chunks. Like $500 in an investment just makes total sense. Comparatively, if you're investing, let's just say you have $10 million to invest. Well, in that case, a 0.5% position is, I'm pretty sure, $50,000 if I did the math correct, right? And it's like, all right, if you're investing $50,000 in something and that thing like quadruples, well, that's 200 grand. Like in absolute money terms, that's a huge amount of money. So the allocation percentage has decreased over time as the absolute total value of my portfolio has grown. So that's just an important point that's worth making. I forget what your other question was aside from valuation. Oh, how do I know I'm wrong? Yeah. Broadly speaking, there are a few reasons that I will take action and sell a stock. Number one is by far the most important. Number one was I was wrong. And the number one reason I'm wrong is thesis is busted. Okay. So the reasons that I made an investment in the first place were proven to be incorrect. One recent one that I was recently proven wrong on was Grubhub. A few years ago, I was an investor in Grubhub. At the time, a big part of my thesis was this is the top dog in the food delivery space, which it was. And I said, I believe that this company is protected by the network effect, where the more diners that are on the platform, the more restaurants that are going to come on the platform. And this is naturally a winner take most kind of market. Yeah. Then what proceeded to happen is Grubhub lost market share to DoorDash consecutively for quarter after quarter after quarter. And the company, which was profitable, said, we're going to be significantly ramping up our spending on sales and marketing, and we're going to go from profitable to being a loss. Gotcha. Now, why would a company do that if they had this unassailable moat that I thought that they have? That is an example of I thought X was false. I was wrong, admit defeat, sell and learn. Interesting. So you're not waiting for the stock to go down X% below your entry price or any of that kind of stuff. You're looking from a fundamental standpoint. If your thesis is just wrong because they're losing market share or they're not growing at the rate that you expected or whatever,
then you blow out that way, not based on the price of the stock moving up or down X% or anything along those lines.
Nope, has nothing to do with the stock movement. Broadly speaking, I want my capital in my highest conviction ideas that I believe we're going to go up over time. And if I was clearly proven to be wrong about a company, I'm going to sell. The vast majority of the time that happens, I'm down. I've lost money on a position, but I've learned an important lesson. About that. So I've paid it's the best tuition that you can pay, I believe, is losing money on an investment. You're like, I guess I'm going to learn something really important. I wish I learned it a different way, but apparently it's going to cost me money. Other times that I would sell would be if the company got acquired.
Okay.
If the company makes a massive acquisition that is thesis changing. So for example, a few years ago, I did not own it, but a lot of people were really high on Teladoc right. Health. Yeah. And at the time, Teladoc, which was acquisitive, made this massive acquisition of Livongo Health. And that was like a $17 billion company acquiring a $16 billion company. Yeah. That is thesis changing. That is thesis changing for a company. Conversely, if Apple buys a $5 billion company, who cares? It's irrelevant, right? It's not thesis changing. So if an acquisition came across that was thesis changing, I would perhaps sell. If there's accounting irregularities or accounting, like we misstated our numbers, that's okay. You're dead to me forever. See you later. And I have a couple more, but the other one I'll throw out there is my favorite reason to sell, which is I need the money to spend in real life, AKA the reason we invest in the first place. So I've sold out to finance a kitchen. I've sold out to finance an automobile purchase, etc. But number one, thesis busted is the most important by far.
I love that. So you mentioned lessons, which is a perfect segue to my next question. What are some timeless lessons you've learned along the way that you'd like to share with the audience?
Well, that depends. Timeless investing lessons or timeless money lessons?
Go anywhere you want.
Yeah. Okay. Both. So I'll say I'll go with timeless money lessons. We'll take it all with the please and thank you, Brian. That's what we do. Timeless money lessons first. I would say that the most powerful, the number one thing that people listening can do to build wealth for themselves is increase their savings rate. Period. Okay. End of story. I personally believe that focusing on saving more money is the number one thing that people can do to make themselves wealthy. If you're saving more money, it doesn't matter to me if you're using that to pay down debt, or just build a cash balance, or making investments. Even if they're bad investments, you have so many more options if you just have more money to invest. So how do we save more money? Two main strings you can pull. One is cut expenses. That's the one that people hate. Yes. But I firmly believe that everybody, if you audit your life, including me, will find dumb things that you're spending money on and stop spending money on those dumb things. Number two is increasing your income. And there's a bunch of ways that you can increase your income. Upskilling yourself if you have a job with high income potential, potentially changing jobs, changing careers, mastering negotiation, starting a side hustle. There's numerous things that you can do as a human to increase your income potential. So I'll say that's fundamental, right? It doesn't matter how good of an investment you are. Somebody that's saving $10,000 a year is going to do way better than somebody saving $1,000 a year that's a master investor. Just period, end of story. Yeah. So that would be thing one. Thing two that I will say is ask yourself what you want from an investment. What is your goal for investing? I firmly believe that 99% of people should just buy index funds and call it a day. Right. The reason I think that isn't because I don't think people are smart enough to pick their own stocks or smart enough to analyze business. I just know from experience that only about 1% of people enjoy investing, enjoy digging through SEC filings, listen to conference calls, talking with other investors, right? It's a niche thing to do. I couldn't agree with you more. Yeah. So if you don't enjoy the process of investing, no problem, buy index funds and call it a day. Right. Yeah, no, I couldn't. It's such a powerful lesson. Okay. Timeless mistakes. Oh, wow. I've made a whole bunch of those. Yeah, and every time I make a mistake, it costs me money, but I learned something important. On an individual level, one of the most costly dollar mistake that I've ever made involved two things that I didn't fully appreciate. The first is leverage.
Okay.
And the second is a dependence on an outside force. So the biggest dollar investment that I've taken so far is to make a company called Kinder Morgan.
Yeah.
The energy pipeline company, my
Right.
number one equity position. And in addition to that, I layered in a bullish option positions on top of that called the synthetic long.
Okay.
So I was really betting that Kinder Morgan stock was going to go up over time, because I was so convinced that the business was rock solid. The business was low risk. It was well managed, paid a dividend, and had a realistic growth plan. And importantly, I believed that the company was immune to energy price swings. The business model made itself immune to energy price swings. Then the stock proceeded to fall 70%.
Right.
So not only did I lose money on my number one position, I lost money with leverage.
Options.
Okay.
Yeah.
And I forced myself to take a massive loss on there. What I really got wrong was, one, over allocating to a single position based on my conviction, which proved to be incorrect. And two, the lesson I really learned the hard way is some companies are heavily dependent. Success is heavily dependent on a factor that is completely outside of their control. Every oil company out there, no matter how well managed it is going to do terrible things if oil prices fall, period. And that is a factor that is completely outside of the management team's control. Same for every commodity producer out there. Same for banks that need high or low interest rates to make money. Same for industrials that need a strong economy in order to print cash. Because of that, one of the biggest point docs that I have on my investing checklist is if a company is dependent on an outside force for the investment to work out. Business is so hard and there's so many things that can go wrong. I don't want luck to be an additional factor that gets added into the equation. So when I look at like a company that more recently I've just completely avoided is Coinbase. And Coinbase checks a lot of boxes. For me, founder-led, top dog and first mover, important emerging industry, high inside ownership, good Glassdoor ratings. It was ridiculously profitable when it came public, but I passed because I was like, doesn't matter how awesome Coinbase is. The only thing that matters is crypto prices, period. End of story. And this company does not control the price of crypto currency. So that's a company I'm never going to invest in. And that is thanks to losing a whole bunch of money on Kinder Morgan.
Right. I love that. This is awesome. Okay, Brian. So what's the best piece of advice you give your 20 or 30-year-old self? The highest return, I firmly believe in the Ben Franklin quote. I think I'm going to butcher it, but it's the investment education pays the highest returns. Yeah, investing.
To me, the foundational step to everything that you want in life is educating yourself. Self-education. If you want to do well with money over time, educate yourself financially. If you want to do well with your health over time, educate yourself on health. If you want to do well with relationships, educate yourself about it. The good news is it's never been easier or cheaper to get that information. What's rare is the willingness to go out and seek that information and learn the lessons. So my number one advice to myself 20 years ago would be, I would have given myself the exact book that I did to start my journey just earlier. Yeah,
I love it. I love it, love it, love it. So, okay, wonderful. Now, do you invest in private businesses?
I do not.
No. Any interest in that?
No.
No. And now the next question would be why? Do you prefer liquidity in the stock market, or like, because you're a very business focused person, you invest in businesses? Is it something that you just have no interest in managing the day to day or being an investor in, or is that, like, in other words, why the stock market is the question? Yeah. So the another asset class that I've looked at intensely, but I ultimately passed on, was real estate. Okay. And that is because I know myself. Yeah. If I had to evict somebody out of a rental property that I owned, I would not sleep for weeks. I would want to throw up. I would be so willing to go out of my way to give that tenant everything that they wanted. And of course, my returns on that would just be awful. And any potential gains that I would get from that investment would be overshadowed by the negativity brought on every other part of my life. So I think that real estate is a fantastic asset
class. And there are lots of people that do very, very well with it. It's just not for me, with the sole exception being REITs.
Yeah.
Because REITs, I can buy or sell unemotionally. I can collect the dividend on, and I can get in and out of very, very quickly. That's not to say that I won't ever invest in private businesses, but the stock market is something I understand. Business analysis is something I understand. I have an edge in the market, and that edge is the willingness and the ability to deal with extreme patience and hold for very long periods of time. So that's what stocks are my asset class that I spend my time and capital on. In the future, it may be something different, but that's what I'm sticking with for the foreseeable future.
Yeah, no, Buffett talks about, right, the circle of competence, or know your lane, stay in your lane, and that's your lane. So stay in the lane by all means. And that's really, really good advice as well. So I guess, Brian, in closing, what's the best way for people to get in touch with you, or grab the book if you have a copy, if you want to share it, or how do people get in touch with you?
Sure. My book is called Why Does the Stock Market Grow Up? It is essentially the book that I wish I could have given to myself 20 years ago. It's aimed at extreme beginners, people with literally zero knowledge, just like I had when I was in that very first 401k meeting. That book's available on Amazon and all book retailers. If you want to connect with me, I'm very active on social media. Twitter is my #1 platform. And if you're interested in my investing style and checklists and all that kind of stuff, I go through all that in details on my YouTube channel, which is my name, Brian Feroldi.
Beautiful. And your Twitter handle is the same name?
Yeah, Brian Feroldi. Yep.
Gotcha. Well, Brian, this is awesome. Thank you so much for coming on the show. We really appreciate it.
Thanks so much for having me, Adam.